Good morning. Welcome to Market Monday for November 17th, 2025. Do you remember this guy? This quirky, unconventional, stubborn, maybe savant is none other than Michael Burry, the eccentric medical doctor turned hedge fund manager who famously shorted the housing market before the global financial crisis. Of course, the 2015 movie, The Big Short, being inspired by him. Naturally, when we're investing, we're dealing with an unknown future and the big bad world out there. There's always something to be worried about. Well, it was just last week that the same Michael Burry wrote a letter to his investors announcing that he was shutting down his fund, Scion Asset Management, noting, "My estimation of value in markets is not now and has not been for some time in sync with markets." Even apologizing to investors. He's not wrong. Here's one of his most famous or infamous tweets from January 31st, 2023, where he tersely says, "Sell." And here's the S&P 500 stock market since then, up 74% in a little less than 3 years. Ouch. Folks, we all want to know the future. It's so tempting to listen to people who previously predicted the past. If they got it right once, doesn't that mean that they have a sixth sense and will continue being right in the future? If it only worked like that, and in reality is probably more the opposite. But even way more important than that, we must remember, what are we trying to accomplish? What are you trying to accomplish? Michael Burry was placing very asymmetrical trades with huge payoffs if he's right. He's not accumulating wealth for retirement. He's not creating an income stream to live off during retirement. Totally different goals, even if he was right. Same goes for this guy. Amazing investor. Great personality, totally different goals. Berkshire Hathaway is a conglomerate. One company, Geico, the insurance company, is wholly owned by Berkshire. When Geico customers pay their premiums, that's cash paid to the company that they have to do something with to prepare for future claims. Here's Buffett in his own words. "We get to invest this float for Berkshire's benefit." Do you own an insurance company collecting premiums from customers? So when Buffett raises cash, again, let's remember, what are we trying to accomplish? For example, here's Buffett's cash pile at an all-time high. Yikes. See that? Wait, that was from a year and a half ago. S&P 500 stock market up almost 34% since then. Had that cash been invested in the S&P 500, he would have made over $60 billion with a B dollars. Good. Doesn't matter. What he's trying to accomplish is up to him. So now we have these other headlines a year and a half and 34% later that Buffett's cash pile is now at yet another new high. Good for him. It's been rising pretty consistently over time. Can you imagine if this cash had been invested over the past 5, 10, or 15 years? Again, totally different goals. We always need to remember that. At the tail end of last week, however, we did get the first meaningful sell-off since tariff tantrum in April. While Thursday's sell-off in the Dow Jones Industrial Average was over 800 points, yikes, 800 points, that represents a 1.65% decline. While 800 points is the 40th largest decline in history, 1.65% ranks as the 1,609th drop in terms of percentage drops, which is all that really matters. So beware when the news and media quote the drop in the Dow in points. And today we'll leave you with Remember how at the beginning, how I mentioned there's always a good sounding reason to be nervous as an investor? Natural disasters, pandemics, recessions, depressions, wars, assassinations, geopolitics, stock market bubbles. Yet, just last month, this just closed at yet another new, fresh, all-time high. Have a great week.